What drives the gold price? You must have heard that the gold is a safe haven. You may think that the recent escalation of tension between the US and China is the invisible hand that skyrocketed the gold price. You saw the gold price shooting up when there was a pandemic outbreak, when there was trade tension, or when the US started the invasion of Iraq. After studying the past 45 years of gold history, I find out that these events have an immediate impact on gold, but they're not the ultimate drivers. So as an investor, what are the most important factors you can monitor to determine the trend of the gold price? Let's look at war first, which is the type of tension with the highest intensity. From 1975 to 2015, there were numerous war occasions for us to study. The late 1970s saw many upheavals, including the Iranian Revolution in 1978, the Iran-Iraq War in 1979. This period saw heightened activity in gold prices. Gold price rose 23% in 1977, 37% in 1978, an incredible 126% in 1979. But does war equals rising gold price? Let's look at more examples. During the first Gulf War in 1990, when Iraq invaded Kuwait, gold prices soared again. But as the talks of war continued, the gold price soon returned to pre-war levels. It continued to go down after the war was over. By the end of 1991, the gold price level was as low as pre-invasion. The same trajectory of gold price happened during the 9/11 attack. After September 11, 2001, gold prices surged. 2 years after, in 2003, when the US started the Iraq War, gold price continued its upward trend. But while more and more people realized the war would soon come to an end, gold prices reverted to its pre-war level. What we can learn from these examples is, when fear of war or fear of uncertainty peaks, gold prices peak as well. This usually happens prior to or at the beginning of a military action or a potentially destructive event. But after the immediate price rise, the gold path diverged. More recent examples are tension with North Korea in August 2017, when President Trump warned North Korea could be met with fire. Gold prices raised on the same day but fluctuates afterwards. The same immediate rise can be seen at the start of the US-China trade dispute in January 2018, but the price surprisingly fell while the US-China trade war ran in full motion between July and September. See, the reason gold prices go up prior to or at the beginning of an economic catastrophe is investors are not able to judge how this crisis would unfold and the extent of the destruction. So people's immediate trading logic is to rush the gold for hedging. Once the crisis starts developing and people are getting more understanding of the crisis, the price will revert to the fundamental drivers of that asset. For gold, they are expected inflation and nominal interest rate. Let me explain using the development of coronavirus. As I just mentioned, in the initial phase, the evolution of the pandemic wasn't given time to be analyzed, so the investors turn their heads to what they think is one of the safest options, gold. This makes the gold price go up. It happened starting early February when more and more people are starting to realize that we might be facing something catastrophic. In the second phase, as the initial fear eased, people started to take time and understand the impact. Now the attention changed to fundamental drivers of gold prices, expected inflation and nominal interest rate. This largely started at the end of February when the gold price dropped along with the stock market. Because at this point, people were starting to believe the economy was facing the chance of a shutdown. It made the expected inflation freefall. On the other hand, people are increasingly assured the Fed will cut interest rate to zero and print unimaginable pile of money. The 10-year Treasury yield started dropping in the second half of February. The gold price dropped because expected inflation fell faster than the fall of interest rate. In the third phase, which we're in now, the pandemic is widely accepted by the market. It already happened. Central banks pumped liquidity into the financial market and the economy. Because the deflation is already priced in the gold price, with the central banks continuing continuous injection of liquidity, markets' confidence in inflation came back that made the price of gold go up again. The third phase started in mid-March when the Federal Reserve cut interest rate to zero and launched a massive $700 billion quantitative easing program. If you use expected inflation minus nominal interest rate since 2003, this number has had an 89.99% correlation with gold price movement. This means when this number goes up, 90% of the time, gold price goes up. When this number goes down, gold prices go down as well. Now the pandemic is fully digested by the market, you may start worrying about the US and China Cold War. While that's the theme going into the 2020s, that's a huge topic and requires me weeks to study. But I want to remind you to focus your attention on the fundamental drivers of gold. This largely depends on how quickly the economy can recover from the pandemic and the Fed policy. The nominal interest rate doesn't have the basis to go up a lot. The US economy can't get any worse. These are the necessary support to keep the gold at its current level. And I do believe the gold will go up in the long term, but it faces the risk of near-term drawback because there's no sufficient support from oil and the price of copper.